Welcome to the top 5 profitable uses for Bollinger Bands. A Bollinger Band is defined by a set of trend lines plotted with 2 standard deviations, positively and negatively, away from a simple moving average, an SMA, of an asset's price. The best settings are a 10 MBR period and 2 standard deviations. 1. A band squeeze. A squeeze is where the bands come together. This is due to a period of lower volatility. This is often indicating that there will be forthcoming market volatility in the future. This is particularly useful when the market is consolidating or trading in a sideways range. Breakout traders will use this to look at range extensions. You can see here on the Nasdaq hourly time frame how the Bollinger Bands contract and squeeze. This indicates there is going to be a period of volatility. We can combine our wider market knowledge to plan a trade. We see the market is in an uptrend. We see some resistance at the top of the sideways range, and we see the Bollinger Bands have contracted. It's no surprise this breakout happened after these indications, and this was a great opportunity to trade. 2. Fake outs. 90% of market price action occurs between the bands. This means when the price action approaches the edges of the bands, or breaks them, then we become interested in a potential reversal trade. We can see here on the daily GBP-USD Forex pair that our Bollinger Band settings identify many occasions where the price action breaks the bands before reversing and breaking back into the bands before trending. To further strengthen this, we can corroborate highs and lows by using basic pivot points and support and resistance. See here how both the weekly R1 pivots coincide with the fake outs at these points. This type of indicator confluence can give us increased confidence a reversal will occur. 3. Profit taking target. If a reversal is confirmed, then it's highly likely the market will proceed to the centre line of the Bollinger Band. This is the simple moving average in which the standard deviations are based around. Bollinger Band traders usually choose to take at least some profit at the centre line due to the high probability the market will reach it. Look here on gold how many fake outs we have in the sideways trading range. Look how many of them at least reach the centre line, with many swinging it all the way across the Bollinger Band. A profit taking strategy of 50% at the centre line, then closing the remaining 50% at the other side of the Bollinger Band would have been perfect for this price action. 4. Stop loss placement. A key skill in trading is knowing where to place stop losses. Too tight and you strangle the trade. Too wide and you may be overexposed to risk of ruin, or your risk-reward ratio may be compromised. If we have to take a loss, we want to be able to do so as cheaply and effectively as possible. Traders use Bollinger Bands to place their stop loss positions. You can see here when the market is faking out, we're able to place stop losses just above these highs and lows. This means if the market makes new highs and lows, we get out of the trades in a cost-efficient manner, which is key to successful, profitable trading. It also means we get a great risk-reward ratio when the fake-outs do work, like here, because we're able to place tight stop losses. 5. In conjunction with market pivots. I use market pivots a lot for my trading. I use the standard pivot point calculation of the high plus low plus close divided by 3. Here we have the daily and monthly pivot points displayed. Weekly can also be placed on the charts too. We use the pivot points as support and resistance along with Bollinger Band fake outs. What we're looking at are the pivot points outside the Bollinger Bands but close to the edges. Once the price action breaks the Bollinger Bands, we look for the price action to test the pivots where we take trades. The pivots also give us ideal stop loss positions. Those are my top 5 ways to use Bollinger Bands. If you like this content, please subscribe to our channel